Money FM 89.3. Best of breakfast. The bigger picture, only on Money FM 89.3.
Good morning. Welcome to The Bigger Picture. Me, Ryan Huang. Lots to talk about this week as we see geopolitical risks heightening in the Middle East, and also central banks, including FOMC, will be in action this week. And helping us to unpack what to look out for is Daniel Tan, Portfolio Manager for Grasshopper Asset Management. Daniel, good morning. How was your weekend?
Morning, Ryan. The weekend was great.
Good to hear and good to have you on with us as we navigate what is going to be a very tricky week. Let's start first with what's front and center in the news, and that's what's happening between Iran and Israel. That has sent oil prices higher and a lot of risk appetite being sapped right now. What's your take on how things are playing out right now?
All right, on the Iran-Israel war, I think this tightening risk is something that concerns us because the worst case that can happen is Tehran entertaining last resort options such as attacking tankers in the Straits of Hormuz. This would affect global production because around 21 million barrels a day of crude oil passes through the Straits, and that's equivalent to around 21% of world consumption. So I think U.S. will not entertain the notion of that happening. So it could possibly draw in bigger superpowers like the U.S. and also Oman and UAE that owns part of the Straits. These are things that could escalate quickly, and it's something that concerns investors.
Okay, so the conflict could widen even further. How is this being played out in the markets? How are the various assets reacting?
I think the immediate thing was we saw crude rising around 7% on Friday and over the weekend. We didn't see much move on the yen, but gold prices is the other notable spike in prices. So I think the go-to for a hedge against Iran-Israel would be gold and crude oil. Okay. This is the immediate hedges, but I'm thinking yen as well, but yen doesn't move as much.
All right, so a bit of safe haven flow, particularly into gold, perhaps to some extent, the US dollar, and maybe in yen to time to come. So a lot of moving parts as we see how this plays out. How is this going to play out for the economy? Because higher oil prices could mean a bit of a challenge when it comes to addressing inflation.
Starting from the U.S., the recent U.S. data has been resilient, even though we saw low unemployment figures. This suggests that the risk of a U.S. recession remains low. The jobless claim numbers was also came in within expectations, but it will be crucial in the coming next few weeks because if those jobless claims doesn't shoot up in the next month, we think that there will be more catalysts for equity and credit risk market to rally. Going back to Japan as well, we saw Japan exiting a decade long of deflation. BOJ is more likely to raise rates and reduce the widely mentioned supply of long-end JGBs. This could provide some near-term support for the long yen trade. And then on ECB, we saw how they try to navigate around the recent risks that we have with Ukraine, Russia, as well as the Middle East now. After 8 rate cuts in a year and a total of 200 basis points, I think the ECB felt that they are comfortable calling the end of this cycle where they will be exiting the rate cut cycle going into a rising risk environment. So on China as well, I think a lot of talks has been on the trade war between China and US. But I would like to highlight that the China benchmark loan prime interest rate is currently at 3%. It's at the lowest level for a long time. It has come down from 3.8% back in 2021. So a lot of talks has been on the trade war between US and China, but I think China has a lot of room to navigate from here versus the US. So just to talk about some of the numbers coming from the US, mortgage rates was last reported at 7%. And also the trade war doesn't benefit US at all, given that a lot of tariff imposed on China goods are affecting things that you see on Amazon, on Walmart, things like the smartphone, etc. So it will have more impact on US consumer than Chinese consumer if this trade war prolongs from here.
Yeah, there are a couple of things to unpack here. You mentioned the outlook for the U.S. economy is uncertain on a couple of factors. What is this going to mean for the U.S. dollar when you have concerns as well around the fiscal deficit, where there is this bill going through where they are potentially going to have to spend more?
There has been a lot of talks about the fiscal deficit widening. I think a lot of talks have been priced in pretty much. And we have seen this trade unwind by itself over the last few weeks. So the policy introduced by the Trump second administration, including the trade policies after the 90 days truce, actually very crucial risk to the U.S. economy, more so than the 2020 global pandemic. So we expect markets to be more optimistic about U.S. growth in the second half, given that a lot of this trade war risk would slowly unwind by itself. And we have also seen that the FX of emerging markets currency from the start of the year has largely appreciated against the dollar in total returns terms. So this has actually benefited emerging market countries, emerging market corporates more than the U.S. economy, despite the risk that we've seen in the first quarter in April. I think emerging market corporates are better positioned than before because they have a greater repayment ability now, given that the currencies has rose against the dollar. So how it does pan out for the dollar, as to your question on that, I think we see more downside risk to the dollar, especially going to the second half of this year.
Okay, so taking a step back and looking at what you mentioned, emerging markets in Asia might benefit. Is this then the time to start reallocating or repositioning towards this part of the world away from the US?
I think emerging market has suffered a lot. Mainly in last year, dollar has appreciated a lot going to the Trump elections. So just to give you a sense of where emerging market corporate spreads are, they are currently not at the widest, but they are somewhere in the median zone. So I think it's still not too late to go on long on some of these dollar-denominated emerging market corporate bonds.
That's a good snapshot of where things are right now from Daniel Tan. He is the portfolio manager for Grasshopper Asset Management. Daniel, thanks for your time and insights this morning. Great chatting with you.
Thanks, Ryan. Thanks for having me.
All right, catch up with you again soon.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.